the session called Frontiers of Research in Consumer Finance. As a reminder to everyone, please submit your questions in the Teams chat. And with that, I'm going to introduce Jialan Wang from the University of Illinois, Urbana-Champaign, as our first speaker. She will present the paper to pay or Autopay, Fintech Innovation and Credit Card Payments. Thank you, Jialan, for being here, and the floor is yours. So we look forward. Thank you.
Thank you so much. Can you hear me and see the slides?
Yes.
Great. Thank you so much. And I'm really excited to be here with this incredible audience of over 150 people. So much like Sumit earlier, I have also been a regulator, and I love working closely with industry participants as well, as I'll talk about in this study. So, we have limited time to interact in this conference, but please feel free to reach out. I have my email here. And so what I'm going to talk about today is the fintech context. So again, harking back to themes that Sumit mentioned, and thinking about open banking, which we'll be discussing later on in this conference as well. And so hopefully this will be an interesting context, thinking about fintech in the United States and thinking about Autopay as an existing technology, and trying to understand the adoption patterns of that existing technology, its impact on consumers, and how that may interact with new developments going on, such as open banking and the kind of emergence of fintechs. And so, thinking about a lot of themes that we'll be talking about throughout the day today. And thanks for the organizers for putting together such a great program. So like Sumit, of course, I have been working on credit cards for a very long time, over 10 years, not nearly as prolifically or as long as he has. But one thing that I really like about this study is that it does draw upon my earlier work that I did largely when I was an economist at the CFPB. And so this right-hand side graph here is from my earlier paper with Ben Gies looking at credit card payment behavior. So I can think of this current paper as kind of one of a series looking at consumer credit card payments and different angles on that. And so one thing we learned from that study is simply graphing the distribution of consumer credit card payments, you see very starkly this bimodal pattern. So what I'm showing in the graph here is just the histogram, the fraction of consumer payments as a fraction of total statement balance. And so we see, as everyone who's familiar with this context knows, that, consumers are transactors, i.e. they pay 100% of the statement balance nearly all of the time, or they're revolvers and they're paying less than 100%. But in particular, what I showed with my earlier paper is that those revolvers are not paying kind of a random amount or an even distribution of their statement balance. They're all clustered, or nearly all of them, near the minimum payment. So we see if you're not paying down your entire balance, you're paying mostly 5% or less. Close to the minimum payment. And what I asked in the earlier paper is that purely rational behavior, or is that driven by behavioral biases or psychological effects? And I showed that about 10 percentage points of all credit card payments could be driven by anchoring as a type of behavioral bias. And in this current paper, one of the contributions I'm making is asking whether Autopay, which is a technology that allows us to link your credit card with your bank account and automatically pay that balance or part of the balance every single month, does that also contribute to part of this bimodal pattern? And, is that good or bad for consumers? And, what can we expect going forward as we see more interactions between deposit accounts and credit accounts through open banking and other types of technologies? And so what I'm looking at in this paper is trying to, I think, based on looking at the literature, and please let me know of other papers that look at similar things, this is the first paper to try to causally identify the effects of Autopay. And the way I do that causal estimation is to look at two underwriting changes driven by cash flow underwriting, which is another exciting innovation in the market. And another theme of this paper is, one of the few papers looking at the effects of open banking in the market and the effects of the emergence of, fintech players in the credit card market, which we haven't seen that much historically. And so the use of cash flow underwriting is used as a shock to Autopay enrollment, because if you're already linking your bank account to your credit card account for underwriting purposes, then it becomes much easier to link it for Autopay, and I find that nudge does have a huge effect on Autopay enrollment, and therefore allows me to estimate what are the effects of consumers on of Autopay. And I'm going to look at payment outcomes as a primary outcome of interest there. So essentially, in a nutshell, my paper is about what is the effect of enrolling in Autopay on whether or not you pay the minimum payment, the fraction of the payments you pay down, your overall payment behavior on that credit card. And as a benchmark in the U.S., the U.S. is a very interesting market in that we have the most credit card debt of any country, but Autopay adoption is actually not very high. So the CFPB has a series of reports on this. One of the most recent ones in the 2020s showed that Autopay adoption, even though Autopay has been around in the US since the early 2000s, only about 20% of consumers adopt this technology even today. It's been gradually increasing. And so one thing we can ask about from a fintech and technology angle is that thinking about this older technology, why aren't we seeing huge adoption? We know that when a new technology emerges, it's not like instantaneously every single person adopts it. And so, again, kind of drawing on some of the themes that Sumit touched on in his talk and his keynote, unlike some of the studies he mentioned where fintech innovation can substitute away from credit card usage, here I'm looking more at a potential complementarity where if you are already a credit card borrower, open banking or Autopay can allow you to use that credit card product in a different way. And so that's essentially what I'm looking at. And of course, I won't have time to get into a lot of the detailed literature here, but I do draw upon a rich literature on credit card payment behavior, including many of the people in the room, an emerging literature about fintech. Of course, my argument is that financial technology is not new, that we're in a current wave of fintech innovation, but certainly things like Autopay, going back to ATMs, their credit scoring, there have been many, many ways of financial technology, but the current wave is leading to a wave of research studies as well, including some of the ones on open banking that we'll look at later on in the program today, and of course, regulation and competition in the credit card market, which many people in the room have contributed to. So as I've already alluded to, I think of open banking as both a market innovation and a policy innovation. And we know that, in many other countries, they've been adopting versions of this. And of course, here in the US, we're all very closely watching the 1033 rulemaking, and which is kind of related to this study as well, because I'm essentially looking at another way to frame this paper is to think about what are the downstream implications of adopting open banking. What I find is that open banking doesn't just affect, your ability to switch your data from a bank to a fintech and vice versa, but it also affects your, likelihood of enrolling in Autopay. So it affects, there's all kinds of downstream impacts. And I'll also argue that Autopay is a technology that doesn't just apply to cards. Many credit instruments use Autopay technology, and I don't know of other studies in, for example, a mortgage context or an auto loan context that look at Autopay, and it has the potential to have significant impacts on consumers. So I think this is a technology that's worth studying, even though maybe it's not the most sexy or new compared to some of the other things we can study. But we need to understand the adoption patterns of existing technology in order to understand new innovations in the market. So what do I do in my particular study? Again, I use cash flow underwriting changes as a causal instrument for identifying the effects of Autopay enrollment. And I have two different underwriting changes in my study. So essentially, we think of these underwriting changes as things that occurred at a specific point in calendar time. So consumers that applied for that credit card before a certain date were subject to one underwriting standard, and after a certain date, they were subject to a different one that then affected their likelihood of enrolling in Autopay. And, this was not pre-announced. So, there's a constant flow of consumers applying for these credit cards across time, but they did not know that there was kind of changes in the underwriting technology that would then impact their Autopay enrollment. And interestingly, what I think is nice about this study is that there's an increase in cash flow underwriting and a decrease in cash flow underwriting at different points in calendar time, affecting different consumer populations. So I kind of can look at the symmetry of, people who are nudged into Autopay and people who are nudged out of Autopay. And, I'm going to show you the most robust results across different populations, across these positive and negative nudges, which hopefully can add a little more credence and robustness to my effects. And so essentially what I'm looking at the effects of these underwriting changes on the salience of prompting you to enroll in autopay. Again, the kind of idea is that if you've already linked your credit card, to your bank account for underwriting purposes, then on your app, again, this is kind of a more novel type of credit card technology where a lot of consumers are interacting via an app interface as opposed to a traditional banking online interface or even paper. You just get another screen on your app that says, oh, would you also like to enroll in autopay? So it just makes it slightly easier to enroll in autopay. And I find that even this tiny nudge has a huge effect, as I'll show you in a moment. And then I'm going to use these nudges to then study the effects on payment outcomes. So that payment distribution that I showed you earlier, I'm going to look at, does it affect your likelihood to pay the maximum payment, the minimum payment, things in between, your likelihood to become delinquent, etc. And that's essentially the study in a nutshell. And to preview my results, I find that autopay has a huge effect. So I think that the first stage effect is a result in itself, in that, the small nudge against, the causal instrument is simply getting an additional screen on your phone at the underwriting phase that says, do you also want to enroll in autopay? Even though autopay is available to all consumers at all times, it's simply a more salient prompt to enroll at the underwriting phase of opening your credit card. And this has a huge effect. So if I take my results literally, that simple nudge actually accounts for half of all autopay enrollment in my sample. So essentially going from baseline of about 20%, similar to the general population, if people are nudged into autopay by cash flow underwriting, that will double to 40%. And so, this is large, economically important. And one of the takeaways of my study is that the effects I'm finding are very, very large, in the double-digit percentage points. And so autopay is something we should pay attention to. And then, moving on from the first stage effects, looking at the causal effects on payment behavior, the most robust and consistent effect I'm finding across both underwriting changes across, this is a regression discontinuity design. So I have a million different tables in the paper of different ways to estimate that effect and different polynomials and things like that, which I will not bore you with. Over and over again across both underwriting changes, a positive and negative nudge, I'm finding that there's a large effect on minimum payments. And again, this is economically huge. Essentially, if we take the results literally, if everyone is nudged into autopay, that will double the fraction of consumers making minimum payments. So again, this has huge effects on the payment distribution. And going back to the motivation of that bimodal distribution, what I'm finding is that autopay does have an economically large effect. So I think if we take these and extrapolate them to the whole U.S. population, autopay itself can contribute to 5 to 10 percentage points of all minimum payments in the U.S. market. Of course, I would caution us against, taking a fintech context, which is a small sample and, different from the U.S. population in many ways and, extrapolating completely, but that's really the economic implication of the effects that I'm finding. All right, so before moving on to the actual effects, let me just make things concrete a little bit. I've been using the word autopay over and over again. So what exactly do I mean? So this is what it means in the fintech app context. So this is a stylized representation of what the screen would look like if you're a consumer of this app. So if you enroll in autopay, essentially you can only choose the statement balance and the minimum payment. This is consistent with what many consumers will see in the market. So if I go to my own, credit cards online, which I don't use a mobile interface typically because I'm very old, I would see a pretty similar set of options. And mechanism-wise, why would autopay contribute to minimum payments? Well, you only have two options generally. I do see that that's changing. Anecdotally, more credit cards are offering intermediate payment amounts, or you can choose your own dollar amount. And these are the type of innovations that I think are really interesting. And I love, again, this study would not be possible without my wonderful anonymous industry partner, but I love talking to industry participants about how can we innovate? How can we use that cash flow data, just like Sumit was talking about, to actually improve consumer? We have so much wealth of information, the financial service providers, and I personally believe we're not fully leveraging it to help consumers and, promote your business at the same time. And I think Autopay is a great example of that. We can use if you already linked your deposit account, we know so much about your ability to pay in a certain month. Why are we still only giving consumers two options, full balance and minimum payment? We can do much better than that. And I really think ultimately that's the takeaway from my paper for policy and for industry. It's not that is Autopay good or bad. I find that it's ambiguous, but it's, how can we do better on this, kind of 2-decade-old technology? How can we use cash flow data and other types of innovations and the app, very interactive app interfaces to improve Autopay so that it actually does help consumers instead of has more of an ambiguous effect, as I'll talk about in my results. So this is what it looks like if you enroll in Autopay. And then, this is purely a nudge context in that I'm not making Autopay available for some consumers and not others. Consumers at any time can go to this screen. It's simply that they get like this extra salient reminder at the time of enrolling in that credit card to enroll in Autopay. You can always turn it off at any time. And even if you're enrolled in Autopay, you can simply go to your dashboard and hit that Pay Now button on the left-hand screen there, schedule payment. You can even override your Autopay 3 days or more before. This is very, very flexible. You can make another payment on top of your auto payment. And this is very simple, very easy. So, we think that the frictions for payment are already reduced significantly in this app context, but yet I'm still finding really big effects. And so again, you can override your auto pay setting anytime. You can cancel your auto pay anytime. And I think an interesting research question is, do we see consumers actually doing those things? And again, this is a screenshot of my personal credit card, my Citibank credit card, showing that, I see a very similar set of options, essentially minimum payment or full payment. And I can write in a custom amount as well. But as we know, when we study consumer behavior, nobody uses that custom amount box. And again, I think we can do better. And for the regulators in the room, the CARD Act was already mentioned earlier. And we have studied. So in my work, I've also studied this CARD Act nudge of paying the amount that would amortize your credit card debt in 3 years, as opposed to just the minimum payment. And we found, of course, that nudge did have an effect, but it was less than 1 percentage point because kind of as regulators, we were a little bit behind the curve in the adoption of online interfaces, fintech interfaces, et cetera. So I hope that as regulators, we're not behind the curve this time, and hopefully this paper, helps us advance our understanding of current technologies that people are as they're using them today. So very quickly before getting into my results, and I do want to leave time for questions as well. I really appreciate this audience and the expertise that you're bringing to the table. So I do want to caveat all of my results here by emphasizing that this is a fintech consumer base, and I think there's pros and cons with working in a fintech context, in that unlike my earlier work that I showed earlier with CFPB regulatory data that was representative of essentially the vast majority of the credit card market, the fintech context is not representative. We see that the typical income or credit score is lower than the typical population. The auto-pay enrollment, as I'll show, is actually quite similar. And so I actually personally do think that the auto-pay results, the fact that auto-pay increases minimum payments, and also mention that there's a great set of studies in the UK, completely different context, completely different research team that are finding consistent results. And so because, that really gives me confidence in my effects in that, although they didn't, exactly identify the causal effects of autopay, but because we found similar and consistent results on delinquencies and minimum payments, I do think that these results will generalize to the general population, that these are more fundamental behavioral kind of psychological effects on consumers, as opposed to something very wonky about my specific context and the kind of lender that I'm working with or population that I'm working with. But I do want to make clear that these are, what you would consider fintech consumers with lower credit limit cards, higher APR cards. So, we would need to adjust. I don't think the numbers would translate exactly. for the general population. On the other hand, the pro of studying fintech is that, this is the future. And so, we'll see the population shifting a little bit, and there's some, noise in the estimation. But I think that there's still a lot we can learn from fintech, and we shouldn't kind of throw the baby out with the bathwater simply because it's not necessarily representative of the full population. And purely from a descriptive perspective, this is that same payment distribution. Even though it's a different type of population, this picture looks remarkably similar to the general consumer population. This is also a significantly later time period in the late 2010s and 2020s instead of the 2000s, like my earlier study. All right, and I'll skip that. So I'll spend the next 5 minutes or so talking through the regression discontinuity design and my key results before opening up to questions. And so here again, as I very briefly mentioned, I'm looking at a change in underwriting of increasing or decreasing the fraction of consumers subject to cash flow underwriting at a specific point in calendar time. So we can think of these as almost date of birth effects. So it's the date of birth of your credit card. And so I want to spend a few moments talking through these graphs. So this is just a very simple, very standard regression discontinuity design where I'm throwing in a number of different polynomial designs, smooth polynomials across the origination date as the running variable to identify that causal effect of autopay on payment outcomes in the first equation that I'm showing. And one thing that's interesting about this context is that, I'm going to, again, in the paper, I can show results with a number of different robustness checks, a number of different bandwidths, and I have a very rich set of controls. And so if we think that it's not autopay that's causing the payment distribution to change, but that again, one drawback of the fintech context is that, your consumer population is changing around more than, if you were Chase. They've been around for so many years. They're getting a very steady stream of consumers. In a fintech context, they are experimenting and changing things around. But I do have very rich characteristics of consumers. So if there's something else that's going on that's causing autopay, it would be hard to argue that that's totally unrelated to your account age. The lender knows a lot more information about you than I can necessarily see, but that's going to be factored into your the APR and the credit limit that they're going to come up with for that consumer. I can put in very rich non-parametric controls, and the results are almost identical with and without controls. And so the idea that there could be another unobserved variable completely uncorrelated with your Vantage score, your income, your age, all of these things, and yet, it doesn't move those coefficients at all. It's harder to argue. Of course, I want to be totally upfront that I cannot totally disprove, of course, selection and unobservables, and that is an important caveat to my context as well. But I know a lot about these consumers, and those things do affect autopay and do affect minimum payments. So it's not the case that these are not good controls. But let's spend a few seconds on this graph here because I'm going to show you a lot more like it, and I want to make sure we understand it. So here, the vertical lines are kind of date of origination. So each credit card originated in my sample is only going to appear in one of these data points that I'm showing you. And so we can think of these vertical lines as specific points in calendar time. So let's say March 15th or August 2nd. These are kind of just random dates where the lender decided to change its underwriting strategy. And we see, let's focus on the left-hand side graph here, that in the orange triangles, in the first experiment, they decreased the fraction of cards that were required to undergo cash flow underwriting. And as I mentioned, if you do undergo cash flow underwriting, you get an additional screen that says, do you also want to enroll in autopay? So I decrease cash flow underwriting, the fraction of people who experience an autopay nudge goes down. And so I see that at the exact same time cash flow underwriting goes down, the fraction enrolled in autopay goes down, sharply and discontinuously, where it was pretty flat on both sides before and after. And if we take this, this is just graphing the raw data, no regressions, no anything. We show that autopay goes from about 40 percentage points to less than 20 percentage points of the population. So if we take this effect literally, that simple nudge accounts for half or 20 percentage points of all autopay enrollment in the sample. So, I think this shows that consumers are very susceptible to nudges. And again, I think this literature, we could develop it more in the consumer finance research that we know a lot about household savings behavior, the retirement savings. People are susceptible to nudges. This affects their savings rates over their life cycle, but we haven't studied this to the full extent in the credit markets. And it doesn't necessarily factor over. Saving is very different from borrowing. And so I think that this is another really exciting area that I'm excited to contribute to. And same thing on the right-hand side, instead of a decrease in cash flow underwriting, I'm seeing an increase. And so we see a kind of symmetric increase in auto-pay enrollment. So that's what I'm using as my first stage or my instrument for auto-pay enrollment. I'm going to, I think, running low on time. So I'm going to zip forward to the results before opening up to questions. What I'm showing here is that these effects are persistent. So you might think that, okay, I'm nudged into autopay, but then I realize I actually don't like this technology and it's not optimal for me. So I'm going to switch away. And especially because this is an incidental nudge that was not intended or targeted to consumers, or that consumers did not self-select. But what I find here is that for at least 6 to 10 months after you open that credit card, your auto pay decision sticks, whether it's a positive or a negative nudge. And so this shows that that nudge is persistent and doesn't go away, that people don't switch out if they are nudged into a setting that they find that is not necessarily relevant for them. And so the key result here is that if I use that instrument for auto pay enrollment, looking at the payment distribution, the biggest and most robust result I find across all different specifications in both experiments is that it has a huge increase in minimum payments. And so what I see here is that on a baseline of about 20 to 30 percentage points of consumers paying the minimum, auto pay, if I move consumers from 0 to 100% auto pay enrollment, that will more than double the fraction of them paying the minimum payment. So I can interpret these coefficients 0.29, 0.27. That's 29% percentage points of all consumers. So these are huge economically, double-digit percentage points of consumers. So that's a key takeaway of my paper, is that autopay has huge effects. And I don't have too much time to go into more detail. I'm happy to talk more, but just to wrap up my presentation part, I find that auto-pay enrollment is sensitive to nudges, in particular ones driven by open banking, a really exciting innovation in the market, and that the key effect is that auto-pay dramatically increases minimum payments. I do find that it decreases delinquencies in one of the two experiments. So we do see this trade-off. And so if I was to say in a nutshell, people ask me, so, does your study say autopay is good or bad for consumers? What is our takeaway here? My answer is that, it's ambivalent, because it could decrease late payments and decrease late fees and things like that can are bad for consumers, but then increase minimum payments, which can lead to higher interest costs and higher debt accumulation. So on average, of course, we want to quantify those things, and for the average consumer, it may balance out one way or the other, but it's not necessarily clear. And so my takeaway is that we can do better than autopay as it exists, and we can use that cash flow data to create a new technology that will unambiguously help consumers and potentially help firms, because firms don't want people to charge off or become late either. And so it could be a win-win, but we're not there yet as far as our current adoption of technology. So I will end there.
Hey, thank you so much, Jialan. That was very interesting. So I'm going to take some questions from the audience. So one question is the following. So autopay is great if the consumers have sufficient funds in their bank account, but what if they don't? And how does this autopay affect consumers with different credit scores and financial literacy levels? How to ensure that vulnerable consumers are not left behind, basically? That's one question. Thank you.
Yeah, and so I would definitely point you to a great paper by Paulina Medina, who is going to be later on in the program, who has looked at this interaction between your overdrafts and things like that, and making the payments on your credit card. So that does show a potential negative effect. And one reason auto pay adoption is only 20% in the US, I think anecdotally we do see that consumers say they're afraid of overdrawing their bank accounts. And we know that there's very high fees. And so one thing I haven't done in this study is to kind of segment, because I only have 60,000 consumers. My ability to, kind of more precisely estimate effects on some populations is pretty limited. But I absolutely agree that, again, this confirms my takeaway that autopay as it exists is pretty ambiguous, even for the average consumer, much less the more vulnerable consumer, but that we can do better. We can do better than just prompting them to pay the minimum. We can say, oh, you just got a bonus this, we saw in your cash flow data, you just got a bonus this month. Why don't we pay down your credit card more? And you can save on interest costs. So we can do better to customize it. But I agree with you ultimately.
Thank you. Another question is, do issuers reduce the interest rate to clients that autopay? What are the effects of interest rate on the decision to autopay? Thank you.
Yeah, that's a great question. So I don't have industry-wide data, and I think, the Fed system, we do have some regulatory data. I don't know if you even have the variable on whether they enroll in autopay or not. Certainly, I've gotten a 1 percentage point APR discount on my auto loan because I autopaid it. I haven't heard of that in the credit card industry, but it would be natural, and I do find results showing that autopay reduces delinquencies and therefore credit risk. And so there's implications for the credit risk side as well. But I haven't heard specifically, and would love to hear from the industry participants here, of a specific example of issuers doing that. It would be a natural thing to do.
Thank you. I'll take one more question and then we'll move to the next paper. Can the autopay nudge be extrapolated to the use of other digital services, fintech startups offering services like auto loans that may lead to consumers working against their own best interest in a relatively unregulated space?
I don't know. I do think that, this paper opens up the idea that, autopay is available in other contexts, such as auto loans. And in particular, I would point out that this bimodal distribution, we think of it in the credit card context, so many people are paying the minimum payment. That could be a policy problem, but that's true for student loans, auto loans. In most loans, there's no prepayment penalty. And so we know that consumers' liquidity changes over time. So it may not be economically rational for them to pay the scheduled auto loan payment that again, if they get a bonus or get a new job, it may be optimal for them to pay down more. But we're finding these defaults may kind of lead them to pay less. So I do think this autopay result can extrapolate to autopay in other contexts, but I don't know about, extrapolating even more broadly to adoption of other types of things. We need to study those things, but I do think we should study autopay in other consumer credit contexts as well.
Thank you so much, Jialan. We will now move to the next paper. So we have Lulu Wang from Kellogg School of Management, Northwestern University. He's going to present his paper on regulating competing payment networks. And Lulu, the floor is yours now. Thank you.
Thanks for having me. My name is Lulu Wang. I'm an assistant professor of finance at the Kellogg School of Management, and I'm excited to be here to share my work on regulating competing payment networks. So consumer payments in the US are card-based, concentrated, and costly. So out of 10 trillion in consumer payments every year, around 8 are done on either credit or debit card. 3 companies, Visa,
are you moving your screens forward? Are you moving your slides forward? Yeah, we're not seeing it.
Yeah, I'm not too sure if you're maybe sharing the wrong window when you hit share.
It's also very small.
There we go.
Yep.
See now.
Great. All right. So I'm sorry for that. Let's third time's the charm. So consumer payments in the US are card-based, concentrated, and costly. So out of 10 trillion in consumer payments every year, around 8 are done on either credit or debit cards. 3 companies, Visa, MasterCard, and American Express, process around 85% of these payments, and merchants pay high fees at around 2.2% for credit cards, which is roughly 3 times various international regulated benchmarks. Now, faced with this kind of market structure, regulators around the world have tried 2 main kinds of strategies. So the first is from, say, a European or Australian approach, which is to directly regulate these fees. So for example, in Europe, they cap the interchange fee, which is a large part of why credit card fees in the US for merchants are so high. On the other end, the US tries to take a more market-based approach. Instead of directly regulating prices, we try to, say, introduce more competition. So for example, when the DOJ blocked Visa's acquisition of the nascent payment platform Plaid, they argued that the merger would have stifled competition that would have otherwise brought down fees in this market. Now, the reason this is a very challenging question to know what to do about is because these markets are two-sided. Payment platforms like Visa need to make sure that consumers want to use the cards at the same time that the merchants want to accept them. And so in this way, they actually compete in the same time in both the merchant fee as well as consumer rewards. In these two-sided markets, a lot of our usual intuitions on regulation and competition just don't apply. So for example, capping fees at cost can actually lower welfare, and entry can actually increase merchant fees, increase rewards, and actually lower welfare. But to empirically evaluate this question, we need to have a model that captures three salient facts about the market. The first is that merchants differ in their benefits from card acceptance, that consumers can carry multiple cards in their wallet, and that merchants, in deciding what to accept, right, are thinking about this as a strategic decision as they compete with each other. And so no existing model captures all three features. And so in this paper, I combine these in one quantitative model and ask, what are the quantitative effects of regulation and competition in consumer to business payments on merchant fees, consumer rewards, and welfare? And so what I do in this paper is that I develop and estimate a two-sided model of payment network competition. So I'm going to model competition for heterogeneous consumers and merchants. I'm going to estimate this model by matching variation from natural experiments. And then I'm going to solve for the equilibrium effects of regulation and entry on prices and welfare. And so my main finding is that capping credit card merchant fees is progressive and welfare increasing, but simply introducing more competition through entry is not. That in some sense, the Europeans got it right and the Americans got it wrong. That capping credit card merchant fees lower rewards and therefore reduces credit card use. Merchants then pass on these lower merchant fees into lower retail prices for all consumers. In aggregate, this creates around $30 billion of welfare per year for consumers, merchants, and networks combined. In contrast, if you simply try to introduce more competition without regulating prices, because consumers are really sensitive to rewards, but merchants aren't that sensitive to merchant fees, entry simply increases this rewards competition without bringing down merchant fees at all. And as a result, more consumers end up using high merchant fee payment methods, which actually lowers welfare by around $4 billion a year. And so the first part of my talk, I'm going to just give a brief overview of how market pricing works in this segment, and then give you some intuition for the results. And so if you think about a typical credit card consumer, suppose they come to my store to buy a $100 pair of pants. There's a sequence of fees between many intermediaries. So the first one is that I might pay, say, a $2.25 merchant discount fee to my bank, who's called the acquirer. The acquirer can keep some of this money to cover their own costs, but then importantly has to pay around $1.75 in interchange to the issuer of this card, who in this case is Chase. The issuer and the acquirer collectively pay around a 14-cent network fee to Visa. And then Chase can turn around and pay some of this interchange as a reward to the consumer. And on average in this market, that's around $1.30. Now, the numbers in blue are directly set by the San Mateo Corporation Visa, but in influencing these prices, they influence the consumer and merchant prices. The reason the merchant is paying a fee is because their bank is paying this interchange. And the reason consumers can get rewards is because their bank is receiving this interchange. Now, relative to this full market structure, I think there's two important simplifications that help us understand the economics of the market. The first is to recognize that that the network competition primarily affects the dimension of these merchant fees and rewards, and not so much the interest rate. And this makes sense because the majority of people who do a lot of this spending on credit cards are doing so as a transactor and not really borrowing as much of that money. This is also consistent with the Australian experience when reductions in merchant fees flowed mostly through to rewards and not interest rates. The second simplification is to treat those three intermediaries as being one combined intermediary. that is jointly trying to set the merchant fee and the consumer reward. This is not really a statement about who is more important in the network, but it's actually consistent with a wide range of market structures. The first is that if you thought that all the issuers and acquirers were perfectly competitive, then this assumption would work, because then Visa is kind of setting the interchange, and then that gets passed on as rewards to the consumer. It also works if you think that Chase has a lot of market power, but that Visa and Chase can bargain under complete information transfers. That even in that case, Visa will internalize what Chase's profits are, and therefore it's also consistent with modeling the market as having one person setting both the reward and the merchant fee for each payment network. Now, in this market, how can competition raise merchant fees? So if we thought about Visa as a traditional one-sided firm, we would focus on its role in charging a fee to the merchant. Under this logic, if a new platform were to enter, we would expect Visa would cut down its margin, take more market share, and therefore bring down merchant fees. But in reality, Visa is a two-sided platform that charges fees to merchants to fund rewards for consumers. In this kind of environment, if a new platform enters, then Visa can actually face an incentive to increase its merchant fee to fund more rewards. So even if retailers adjust retail prices in response, the Visa consumers benefit from the full increase in rewards, but only bear part of the cost in higher merchant fees. This trick works because merchants typically charge one price for all consumers, no matter how they pay. And this trick is particularly effective if consumers are very sensitive to rewards, but merchants aren't that sensitive to merchant fees. I'm going to be showing that this is true in the empirical setting, and so a lot of the modeling and empirical work is about trying to find the right framework to make this point. And so I'm going to briefly talk about the model that I use to think about this market. So in the model, there's going to be three groups of players: consumers, merchants, and payment networks. In the first stage of the game, the multi-product payment networks are going to set fees for merchants, and then they're going to give rewards to consumers. In the baseline model, there's going to be three networks: Visa, MasterCard, American Express, where both Visa and MasterCard set both credit and debit card fees and rewards. In the second stage of the game, the consumers and merchants are going to make all of their adoption and pricing decisions. So the consumers are going to choose up to 2 cards to put in their wallet. And so this blue consumer might carry both a Visa card and an American Express card. Other consumers might only carry 1 card, and some other consumers might only be cash only. And so consumers are going to vary in their preferences, and that's going to explain why some consumers have more cards than others. Also in this stage, the merchants are then going to choose the optimal subset of payment networks to accept. And so, for example, this blue merchant might accept only Visa credit cards and MasterCard debit cards. This orange merchant might accept only MasterCard debit cards. And some other merchants, like the green merchant, might only accept cash. And so merchants are going to vary in kind of how much payment acceptance matters for their sales. The bar down the street where everyone knows your name might be like the green merchant, because card acceptance doesn't increase their sales very much, whereas a blue merchant, it might matter a lot, and that's why they accept cards. And so each of these merchants is going to make an optimal trade-off between the additional sales they get from accepting cards and the additional fees that they have to pay. And then in the last stage, the merchants also set retail prices. And then in the last stage of the game, the consumers are going to make their shopping and payment decisions. And so what the key idea is that consumers are going to buy more from merchants when the merchants accept the cards in the consumer's wallet. So for example, this blue consumer is going to buy more from this blue merchant because the blue merchant accepts Visa credit cards. And so what this means is that the second and third stages of this game create very natural merchant and consumer demand curves for payments. And then the first stage of the game is how the networks compete in the face of those kinds of demand curves. And so in the full equilibrium, the consumers are shopping optimally over all the merchants. The merchants are setting the right retail prices and choosing the right cards to accept. The consumers are putting the right cards in their wallet, kind of trading, thinking about the rewards and whether these cards are widely accepted. And the networks are maximizing their profits by setting these fees and rewards. And so with this kind of model, how do I take it to the data? So to estimate this kind of model, I really need to answer two questions very well. The first is, how sensitive are consumers to rewards? And the second is, how sensitive are merchants to merchant fees? And so on the consumer side, I'm primarily relying on an industry report that gives me a bank level panel of payment volumes at top credit and debit card issuers. On the merchant side of the model, I'm primarily relying on aggregate shares and prices, as well as some data from the surveys and diaries of consumer payment choice. And so, as I mentioned earlier, a very important force in the model is that consumers are very sensitive to rewards, but merchants aren't that sensitive to merchant fees. And so I'm going to be presenting some evidence to this effect. So to study the consumer sensitivity to rewards, I'm going to use a shock to debit card rewards arising from the Durbin Amendment. And so before 2011, debit cards used to have very high interchange fees, and banks would take these interchange fees to pay rewards on debit cards. But after 2011, the Durbin Amendment capped the interchange fees earned on debit cards by large financial institutions, but not small ones. And so large banks stopped paying debit rewards, which used to be around 25 basis points. And so what I'm going to do is use a difference in difference design and compare the debit card payment volumes at these large treated banks relative to the small control banks. And so when I do this, what I find is that as a result of this decline in debit card rewards, large banks' debit card volumes fall by around 30% after the Durbin Amendment. And so this line here, the x-axis is the number of years relative to the policy, and each dot is then kind of the comparison between large and small banks normalized to the time of the policy implementation. Now, this isn't just about large banks shrinking, because actually we see that the credit card volumes at large banks are actually increasing during this time period. And so the interpretation is that even in response to this very small 25 basis point change in rewards, we see a very big change in the payment volumes, suggesting that consumers are very sensitive to rewards. Now, on the merchant side, right, the key idea is that the typical merchant benefits a lot from accepting cards because it boosts their sales a lot. And so to study this, what I'm going to do is I'm going to study the shopping behavior of consumers who say they prefer to use cards versus the consumers who don't prefer to use cards. And this is from the consumer survey data. And the key finding is that consumers who say they like using cards, even after putting in many different controls, are more likely to shop at stores that accept cards. Right. And so this gives us a hint that for the average consumer at the average merchant, right, they are willing to redirect their spending towards the merchants that accept cards, which suggests that a typical merchant actually gains a lot from card acceptance. And so I implement this through a regression where in the transaction data, I regress, does the merchant accept cards on whether the consumer prefers to use cards? And in my preferred specification, it points to around 30% increase in the likelihood of going to merchants that accept cards as for those who say they prefer to use cards. And so this puts in context why merchants are so insensitive to fees, right? Because if your sales can increase by 30% from a consumer that spends cards, that prefers to spend on card, right? That's a very large profit increase relative to say 1 or 2% fees on sales. And so what I ultimately find is that I find that consumers are roughly 10 times more reward sensitive than merchants are fee sensitive. And so this really drives why a lot of the competition in this market is about getting more rewards and not so much about merchant fees. And so with this estimated model, I can then evaluate the welfare effects of different kinds of policies. And so in my simplest example, I think about what happens if we cap the fees on on credit cards. And so the way I'm thinking about this is that I'm just changing the prices that the network sets, but I hold consumer preferences, the merchant benefits from card acceptance fixed, even though everyone's allowed to readjust, say, what cards they put in their wallet and which cards they want to accept. And so if you do this, the rewards fall by a lot. And so consumers kind of reduce their use of credit cards by 30 percentage points. So that's roughly goes from the current level to 1/3 of the current level. And 2/3 of those consumers substitute debit cards, 1/3 goes to cash. And we can then think about the welfare effects of this kind of policy. So the first thing is to think about the distributional effect of these kinds of policies. And for this, we can think about what happens to the consumers who don't change their payment method. In this setting, welfare is pretty straightforward. There's two components to it. The first is that all consumers benefit from lower retail prices. And so this chart just shows grouping people by what they're using in the current equilibrium. On the left, we have the credit card users. On the right, we have the cash and debit card users. So while everyone benefits from lower prices, the credit card consumers are additionally hurt by the decline in rewards. And so when you add up these two effects, what you get is that this kind of regulation helps the relatively lower income cash and debit card users, whereas penalizing the higher income credit card users. Now, this is the distributional effects, and then we can also think about what happens to the society as a whole. Now, to make this argument, I need to make a stronger assumption. So I need to assume that consumers' payment choices reflect revealed preference. In this kind of setting, then we can think about what is it that drives people to use one payment method over another. Obviously, credit and debit cards are similar in many ways. You can avoid carrying cash. On top of that, the credit cards earn you rewards. And so if this was all that mattered, right, everybody should be using a credit card and no one should be using a debit card. But in the data, I actually see a lot of consumers who have access to rewards credit cards choosing to use the debit cards. And so as with Sumit's points about consumers struggling with credit cards and the mistakes, right, the way I rationalize this is that there must be some kind of credit aversion, that consumers don't want to risk getting in debt, dealing with the confusing fees. And that's why on the margin, some consumers don't use credit. Now, if this is true, it explains also why more credit card rewards is welfare reducing. So suppose we increase credit card rewards a little bit and the marginal consumer switches from debit to credit. Now, that's a great deal for them, right? They're getting the rewards that offsets the credit aversion. But for society as a whole, it's a disaster because those rewards are simply a transfer. In fact, they're a transfer paid for by other consumers paying higher retail prices. And so the key idea is that consumers don't internalize the effect of their own payment choice on the level of retail prices. And so therefore, people incur too much of this credit aversion in order to earn rewards. And so you can do this in math. And so then what you'll get is that this kind of force means that consumers actually benefit as a whole by around 40 billion a year from this kind of fee regulation. Now, another thing I do is that I study, well, what happens if we introduce just another credit card network as a form of competition? And what I find is that this actually has a lot of the opposite effects of capping credit card fees. That instead, the new network competes primarily by raising rewards, which then induces more people to use these high merchant fee payment methods, which creates a regressive transfer from debit card users to credit card users, and therefore actually lowers overall welfare. And so you can think about applying this framework to a lot of contemporary policy issues. So the first is that it highlights that even competitive payment networks can have problems in terms of efficiency. And so you can easily have a world where, say, a merger like Discover Capital One is extremely pro-competitive, yet at the same time can be welfare reducing by intensifying this competition over rewards. At the same time, this framework also highlights the key role of the consumer. So the history of kind of new payment methods is something like lots of attempts to try to reduce costs for merchants to drive adoption, but really because consumers are so sensitive to the features and the rewards that you really need to have very concrete use cases for consumers to drive adoption. And so this is, I think, there's some questions about how to think about new technologies. I think the biggest thing about new technologies is to figure out how they address consumer concerns, and because that's a really important force for adoption. And so in conclusion, in this paper, what I did is I developed and estimated this two-sided model for thinking about network competition. And I show that fee regulation helps, whereas competition does not. That because consumers are really sensitive to rewards, but merchants aren't that sensitive to merchant fees, competition merely increases the rewards competition without reducing the merchant fees substantially. So apologies for the technical issues, but I'm happy to take a few questions if there's still time.
Thank you so much, Lulu, for the really interesting presentation. I'm gonna read a few the questions from the chat. So see here. Capping fees may impact underwriting, access to credit cards for low credit score users, and also related to that, are there distributional impacts on consumers from different income groups and segments, and how policies should be designed? Should they be more progressive in nature to consider such different impacts?
Yeah, so I think on the point about underwriting, I can imagine that there's some amount of that effect, but I think the key point is that there's no good reason to be taxing the merchants to be subsidizing more of this underwriting. And then moreover, in places like Australia, where we have seen these kinds of fee caps, we don't really see large adjustments on the borrowing aspects of the credit cards, whereas we see comparatively very large adjustments on the rewards aspects of the cards. In terms of the distributional impact, it's with my chart earlier, right? I think the key idea is that the kinds of consumers that are likely to use cash and debit cards, which we might think of as somewhat lower income, right, are more likely to benefit from this kind of fee regulation than the higher income, more like credit card consumers. I think Amelia had a quick question on the merchants. So I think the key thing is that no one likes paying fees, right? We're all very sensitive to paying fees, but you're willing to take the bargain of getting those additional sales, and you're willing to pay the fees to get those sales. So it's not so much that I'm saying, I don't think merchants are happy about paying these fees, right? But that if you were to offer the merchant this trade-off between sales and the fees, not that many merchants, for most merchants, the sales effect is just way larger than the fee point.
Thank you. Some other questions. Do you know anything about switching behavior to other merchants of the cash payer subsidizing card users? And this, that's first one.
So the way that I model that is just this kind of standard retail competition, right? So if the merchant raises their prices in response to these fees, then I treat that as any other price increase, and then so I expect in the model a cash consumer substitute away from those card merchants. I think the struggle is that in most markets, so many merchants accept cards, and there's really not that much room to substitute.
Thank you. Another question is, this compares transactors versus debit card users. Revolvers have other incentives than rewards, and their welfare initiatives are different. How would you adjust that into the model?
Yeah, so I think of my model as mainly being a model about kind of the big spending behavior and not as much about the borrowing behavior. So I think kind of the credit card market is kind of interesting. It's one plastic product, but it's really two different markets, right? That there's kind of a segment of consumers that do 80% of the interest, but almost none of the spending, and another segment that does 80% of the spending and none of the interest. And so really you should think of this as a model of the welfare of the spending kind of decisions and not so much of the borrowing. And so I'm kind of holding fixed all of those features about the borrowing aspects of these cards.
Thank you so much, Lulu.